Hello everyone, guys. Welcome back to my channel. Welcome to Connect with Uganda. My name is Ray. Thank you so much, guys, for clicking on this video. So today we're going to talk about taxes in Uganda. I know this is a highly requested for topic. I have had most of my viewers ask me, Ray, taxes. So the day has come. I do have discussants from Uganda Revenue Authority. That is the taxing body in Uganda. So I'm going to give us each and everything that you need to know about taxes. They're going to answer your questions. So if you're in the live chat, make sure that you do let me know. Let me know where you're tuning in from. Type questions, all that you need to know about taxes as a business owner, and even foreigners, especially because I know most of my audience are foreigners who want to come and do business here. So all that you need to know about taxes, please ask all the questions. Today is the day. You're going to get all your answers because I have the experts here. That's why it has taken a little bit long, because I've been trying to get in touch with them because I know they have the right information. I didn't want to beat around the bush. So when you join the stream, make sure that you do give it a thumbs up, come to the comment section, let me know where you're joining from, say hello, and yeah, let's do the discussion. So we are going to start immediately, and you guys are going to join whenever you come. So I'm going to add my guest to the stream, and then we can start the discussion. Hello, Jim.
Hello.
Thank you so much for joining the live stream today and accepting my request, my invite.
You're welcome. It's a pleasure joining you.
Okay. So would you kindly start by introducing yourself, and then we join the discussion?
Good evening, good morning, everyone. I believe we are in different time zones. My name is Jim Enokagolo. I'm an officer. I work with Uganda Revenue Authority in the Central Audit Center unit under Domestic Taxes Department. I'm happy to have this discussion with you this evening.
Okay, I'm happy to have you. I thank you so much. So I've already briefed you, most of my audience, people who want to start business or foreigners who want to start Uganda. So I'm going to give you the floor to just give us all the information that someone would need to know in regard to taxes. I'll ask questions along the way, but if someone is a business owner, they've opened their business here in Uganda, assume they are a foreigner, where do they start from with taxes? You can take us maybe through the steps of things that they need to do in regards to taxes.
Okay. Thank you so much, Ray. I'm assuming a person has come to Uganda and wants to do business in Uganda.
Yes.
For starters, a person can come to Uganda. That person can trade as an individual, that is a sole proprietor. That person can also open up a company. It can be a local company, a subsidiary, or he can choose to open up a branch. That person can also choose to open up a partnership. For the sole proprietor, you must register a business name. You can be Jim Kagolo Trading as. So you must register a business name with URSB. For a company, you must incorporate that company or register that company with still URSB. So after opening or getting the business name, or incorporating the company with URSB, then you get a TIN, the tax identification number with URA. That process is basically online. You can apply for a TIN wherever you are, even when you're not in Uganda, as long as you have a computer and internet. After doing that, you have to understand the taxation. How do we tax the residents and the non-resident. The moment you come to Uganda and you open up a company, you incorporate a company, that company is resident in Uganda. So for a resident, even when you are an individual, you're not Ugandan, but you are a foreigner. We have some rules which we follow to determine whether you are a resident or a non-resident. For individuals, we normally look at the number of days they've spent in Uganda in a year of income. Normally we have 183 days. If you spend 183 days or more in any 12 months period, you become a resident. So the moment you are a resident in Uganda, you're taxed on your worldwide income. What are we saying? That you are a foreigner, but you've been in Uganda for a period exceeding 183 days in a year of income. And you have other businesses, say in Kenya. Those businesses you have in other tax jurisdictions will also be taxed in Uganda, since you are a resident in Uganda for tax purposes. So after setting up the company, you've registered with URSB, you've got the TIN, and you are on the road. The company is operational. Let's look at the applicable taxes. The taxes that you're likely to pay to URA once you started operating, either as a non-individual or as a company. These taxes cut across, irrespective of whether you are an individual or you are a company, though the rates may differ. We have pay as you earn. Pay as you earn is normally a tax paid by people who are in employment. If you open up a company, or you are a sole proprietor, but because you're not going to work in the company alone, you'll have to bring employees on board. So the moment you have employees and you're paying them that monthly remuneration, you're expected to withhold pay as you earn at the prescribed rates. We have tax bands. Tax bands that is from 0 to 235,000. 235,000 you do not pay. That employee does not pay anything. So we have those bands from 0 to 235,000. The employee does not pay anything. We have up to the last band, that is from 335,000 to 410,000. The employee there falls in the 30% bracket. So you have to withhold depending on how much the employee earns and the tax band in which that employee falls. That is irrespective of whether you are an individual or a company. Provided you have employees, you will have to pay as you earn. This pay as you earn, if you're a company or an individual, you're just remitting it on behalf of the employee. You're just a withholding agent. After that, we have another tax type called value added tax, commonly known as VAT in short. VAT is a tax that is paid on value addition. It is paid on value addition. And VAT is paid depending on the nature of business. VAT is only applicable on taxable supplies. In the Ugandan tax laws, we have the goods are categorized into 3. We have the standard rated supplies, the zero rated supplies, and the exempt supplies. So depending on where the items or the goods you deal in, if they all fall in exempt sales, then you will not have to register for VAT because what you're dealing in is exempt. If you're dealing in standard rated or zero rated, then you will be required to register for VAT because the zero rated and standard rated are taxable. The only difference is that zero rated supplies are taxed at a rate of 0 and the standard rated supplies are taxed at a rate of 18%. But it is not enough for you to deal in taxable
Okay, a
supplies.
quick question.
Okay.
So explain more again, give us examples of goods that they would charge VAT on and the ones which are not maybe non-VAT, zero standard or no VAT applicable to them. Would you give us like some examples?
Okay, Ray. I didn't want to refer to the Act so much, but in the VAT you have those schedules. Once an item is exempt or zero rated, we have Schedule 2 and Schedule 3 of the VAT Act. Those items are listed and they are amended each and every year. In the exempt, the schedule for exempt items, we have all agricultural and processed agricultural products. Assuming your business is to buy and sell matoke in our local markets in whatever quantities, that is unprocessed agricultural product. So those are all exempt products and they are listed in Schedule 2 of the VAT Act. Then we go to the zero-rated items. We have zero-rated items such as mosquito nets. Mosquito nets, such items, they are zero-rated. We say they are zero-rated, but they are taxable, only that they are paid VAT at a rate of 0%. Then you also have exports. All exports from Uganda are zero-rated. It means if I have I sell a standard rated item, okay? The moment I export it, it becomes zero rated. This was done to encourage people to export, to encourage exportation. So the moment you export, it becomes zero rated. And there are the benefits.
Wow. So,
there are benefits there.
So meaning,
that assuming you've
okay,
incurred,
sorry to cut you short.
Assuming that you've incurred input on your purchases, okay? Transportation of goods from wherever you've got them to the exportation point, you've incurred expenses, transportation, which is standard rated, okay? And you're going to pay VAT on that transport, okay? You're entitled to claim the refund of that input from URA, and you will not account for output since whatever you're selling is an export and the VAT you're charging is 0. So you will be entitled to a refund of your input. That is basically the advantage of dealing in zero-rated supplies. You'll have nothing to pay to URA, but whatever VAT that you've paid, you'll be able to claim it from URA. Is that okay, Rachel? Okay, then to continue with the VAT, there is a registration threshold. Not every person who deals in standard rated, zero rated, what we call the taxable supplies, qualify to register for VAT. In other words, VAT is not God-given, that whoever has a tin must register for VAT. You can apply, you get a tin, the tin will automatically have income tax, but VAT can come in a little later, or you may never register for VAT, okay? So we have a registration threshold of 150 million, that for you to qualify to be on the VAT register, your turnover, the turnover of taxable supplies, must exceed 150 million in 12 months period. This is broken down to a quarterly threshold of 37.5 million. That if you make a turnover of 37.5 million in 3 consecutive months, then you automatically qualify to register for VAT. If you do not make that threshold in any 3 consecutive months, then you're not required to register for VAT, even when what you're dealing in is taxable. Then I earlier mentioned that VAT is charged on value creation, on the value added. What do I mean by this? We have what we call the output and input mechanism. Okay, let me assume you have a supermarket and you're selling goods. Okay, and you're selling goods. Let me assume you've imported you've bought from a local market an item at 10,000. Now, on that purchase price, the 10,000, you're going to be charged the VAT of 18%. That VAT that is paid at the point of purchase is what we call the input tax. Okay? When you get that item and you sell it in your supermarket at 20,000, okay? When your VAT registered, you're going to charge VAT on that 20,000, okay? The VAT that you incurred at the point of purchase, the 18% of 10,000 is 1,800. That is your input, okay? Then the VAT you're charging on the 20,000 at the point of sale, that is the 3,600, is what we call the output. Now the output input mechanism comes in that for you, when you're determining the VAT that you must pay to URA, you get the output, the 3,600 minus your input, okay? Minus your input, which is the 1,800. Yes, so you get the difference. The difference is the 1,800 that you pay to URA. Okay. So how does the value creation come in? It is simple. You incurred 10,000 to buy the item. You're selling it at 20,000. So ideally, your profit is the 10,000. The 20 minus the 10. So even when you get the 10,000, the difference is the value addition. So if you get the 18% of only the value addition, still it will give you the tax you're going to pay when you get minus the input. So that alone confirms that VAT is charged on value creation. And VAT is paid by the final consumer. It is not paid by the people, the traders along the chain of distribution. It is paid by the final consumer. So I don't want the people to be there and say that the rate of 18% is high for a businessman. Yes, it is high, but it is to be paid by the final consumer, a person who walks in your shop to buy the product for final use is the person who pays that tax.
Wow, thank you so much for those insights. So I believe people have understood about income tax, getting a TIN
VAT.
number which they can apply for online, which automatically comes with income tax, the TIN, and then value added tax. It will depend on the size of the business. I think that has been understood. And of course, the products as well that sorry, pay as you, the products as well that the business is going to be dealing in and the size of the business. I think that's understood. So I would like you to talk a little bit about tax that is incurred by people who are in real estate, like a real estate company, for example. Because I know most of my viewers are people who want to do real estate. So do they also incur a pay as you earn, or is it a rental tax for landlords? What do they incur?
Maybe, Rachel, let me first finish with other tax types, then I will answer that. I don't know if that is fine with you.
Okay, that's fine.
Okay. So on top of pay as you earn and VAT, there is what we call corporation
Yes,
tax
it
or
is.
income tax. Okay. So corporation tax, or what we call income tax, it is computed on taxable profits. What do we mean by taxable profits? You get your gross income minus the expenses incurred and the cost of sales. Whatever you remain with is adjusted for tax purposes. The profit is adjusted for tax purposes. Then for companies, the rate for income tax or corporation tax is 30% for companies. For partnerships, a partnership does not pay income tax. Okay? There are some businesses where you can only trade as a partnership. Like most of the law firms, most of the audit firms, they are partnerships. So in the partnership itself does not pay tax. The tax is paid by the individual partners after sharing the profit in their individual profit sharing ratios. I talked about the bands for individuals. So if you are trading, you are an individual and you're a partner in a partnership. For you, the corporation tax or the income tax payable is computed basing on the other bands I talked about, that from 0 to 35,000, you do not pay anything. From 335 to 400 to 410, it is a 20% plus 10,000. Then from 410 going upwards, you pay 30%. Then also have an extra tax if a person earns more than 120 million in a year of income. For whatever exceeds 120 million in a year of income, there is an additional tax of 10%. That is for individuals. For companies, it's a flat rate of 30% only on taxable profits. Then for rental, we also have rental income, which is a form of corporation tax. For rental, we have amendments that effective 1st July 2021. I think let me not talk about what has been happening before. Let me talk on the amendments. For any person having rental or earning rental income, whether you are a company or an individual, okay, we will get your gross income, the gross earnings from rental. Then we shall allow you 75% as allowable deductions for tax purposes. The 25%, what remains, is what we tax, also at a flat rate of 30% for both individuals and companies. Assuming in your income you've got 100 million, that is your gross. So you will get 75% as allowable deductions. That will be 75 million. So the 100 million minus 75 million will give you 25 million balance. So it's on that 25 million that URA will compute 30%, and that will be the tax you're paying. But that is only effective
The 75
from
million
July.
is not deductible.
It is deductible, the allowable deduction, 75% of the gross. The 75 is the allowable deduction. It is deductible for tax purposes. So when you get 75% of the 100 million, it will give you 75 million. So you get the 100 million minus the 75 million to get the 25 million. It's on that 25 million that you will compute 30% and pay that tax as rental. But this is only effective 1st July 2021. Prior, we had different arrangements, both for individual and companies. The arrangements were completely different. This is a new amendment which came in the amendments for this financial year.
So I would like to ask a question again about that 75%. So what you're trying to mean is you do not deduct any tax from the 75%. You only compute the tax of the 35%, and that's what the owner of the property pays to URA.
Yes, the 75% is given as a deduction to cater for your expenses, for the electricity, the garbage collection, the security guard. They are all covered in the 75% allowable deductions. Instead of getting the gross, then you expense these line items: security, water, garbage collection, repairs, and the rest. So they are all bundled up together in the 75%. It is not a must that if you have rentals, you're going to incur expenses to the tune of 75% of your goods. In some years, you will incur 10%, just cater for water, electricity, and security guard. But they've given you up to 75%, meaning it is to your advantage. In a year where you have limited expenses, it will basically be to your advantage. So on top of the
thanks a
corporation
lot.
tax,
That is very clear. So what I've learned so far is that people who are into agriculture, they won't incur.
on top of corporation tax, we also have excise duty.
Okay, so let me read some comments before.
Okay.
Yes, you can proceed.
Okay. On top of those, on top of pay as you earn, VAT, corporation tax, you have excise duty. This is only applicable on excisable items. So if an investor comes, it depends on which products he's going to deal in. If the investor opts to deal in excisable items, then he will have to pay excise duty. Excise duty is a one-stage tax for manufacturers and importers. If you are a manufacturer, and let me first give examples of excisable items. The list is in the Act and has so many items. I'm just going to mention a few. We have water, that is mineral water. We have cement. We have sugar. The moment you opted to deal in these items, we have wines, we have spirits. Mention, the list is endless. The moment you choose to dealing these items and you are a manufacturer, then you will have to pay excise duty at the point when the goods are exiting the factory. Or if you import any of the excisable item, then you will have to pay excise duty at the point of importation. This tax is a single stage tax. Okay, it is paid only at one point. If it is imported, it is paid at the point of importation. If it is for excisable items manufactured locally, then it will be paid at the point of goods leaving the factory. Then you also have excise duty on service. We have excise duty on services. We have on airtime. Recently, in the recent amendments, it has also been introduced on data. So the moment you buy airtime, you will have to pay excise duty, but it is accounted for by the telecom companies. Okay, assuming you buy airtime of 1,000, excise duty is inclusive of the purchase price of 1,000. For if you are an investor, you choose to come and invest in those sectors, all those products which attract excise duty, then you will have to pay excise duty. Then you also have stamp duty. This one cuts across. It is payable on specific instruments. Okay, on specific instruments. Previously, if you would obtain a loan, on those loan agreements, you would pay stamp duty, but in the recent amendments, it was made 0. If you open up a company and you issue shares, you increase share capital, you have to pay stamp duty at the given rate on the increase of the share capital, or on the introduction of share capital in your company. Then you also have withholding tax. Withholding tax, if you're a gazetted withholding agent, normally every after 2 years, URA nominates people who are gazetted as withholding agent. Now, when you are a gazetted withholding agent, for whatever payment you pay to your suppliers, okay, assuming you're Jekagolo Limited, okay, you are a company, then you have a supplier called Isaac. Isaac supplies you with whatever goods or service. If Isaac is not exempt, withholding tax exempt, okay, I must withhold 6% on the gross payment. If Isaac has supplied goods worth 1 million, I must withhold 6%, okay, from that payment. If I'm not exempt for, I'm not withholding tax exempt, the people I supply will also withhold from me 6% of the gross. And this is basically withholding tax. This withholding tax, I would call it an advance tax, because at the end of the day, that 6% will form part of the tax that you will pay at the end of the year. In other words, it's a tax credit. You can use this 6% to offset the final corporation tax that you'll have to pay at the end of the financial year, irrespective of the financial year you're operating. Then last but not least, on the taxes or the duties that are payable, we have the customs duties at importation. We have the customs duties at importation. The moment you import, whether you're registered for taxes or not, you must pay tax at importation. These taxes at importation include import duty, they include VAT, which I've already discussed, and that VAT you pay at importation, if you are VAT registered, you will claim it as a credit. You remember the input-output mechanism. You claim this as a credit for you to reduce on the actual tax you pay. Then you also have excise duty. I've already talked about this. If you import an excisable item, you must pay import duty at the point of importation. Then you also have environmental levy. Environmental levy is charged on specific items. Like if you import a motor vehicle, which is older than 8 years older, 8 years old from the date of manufacture, then you have to pay environmental levy. If you import a vehicle, which is not old, but for more than 8 years from the date of manufacture, you do not pay environmental levy. So these taxes at customs, I've just given a general overview, but they are payable where applicable. What do I mean where applicable? It depends on the item you're importing, and it also depends on where you're importing the goods from. You have trade blocks. You have the East African Community, we have COMESA, we have ECOWAS. Now these trade blocks, they have, some have preferential treatments, that if I import a good from within the East African Community, then I will not pay import duty, okay? So some blocks, trade blocks, have preferential treatment. The duty may differ, okay? Then also the item you import also determines what to pay. When you look at the East African Community Customs Management Act, each product is given a rate at which import duty will be calculated. The rates range from 0 to 25%. We have 0, we have 10, we have 25%, depending on what item you're importing. Then for VAT, VAT is only applicable if you are importing a standard rated item. If you import an exempt item like I earlier mentioned, then you will not be charged VAT, okay? These taxes are charged at importation, but basically they take the domestic element in them. In that, if an item is exempt locally, even at importation, it will be exempt. Then still withholding tax, much as it is imposed at importation, the moment you're exempt for withholding tax, then you will not be charged withholding tax at the point of importation. Rachel, basically that is it. That is it for the taxes payable. I don't know if there are questions before we go to incentives and the tax breaks that may be available to the investors.
Okay, I think. Mm, yes, yes, yes. Okay. So guys, thank you so much for joining the live stream. Big K, thank you for the super chat. Thanks everyone who is here. Hussein, Barbara, NGXP, Fabian, NG. Thanks, guys. So I have a question from someone. I think she joined a little bit later. She's saying if she's dealing with a small business, she's called NG. Taxes for a small business, I understood, I believe that was, according to my notes, pay as you earn. After you've gotten your TIN number, I think you said that was a tax that is applicable to everyone, right? You could maybe just simplify for her what would be applicable to her for a small business.
Okay, thank you, NJ, for that question. I had intentionally left out taxes for small businesses because I wouldn't believe that an investor
Jim,
would
have you
come
heard
to
what I've
Uganda
said?
to really do a small business. But we have different rates for people who are dealing in small businesses. And the smaller
Hello?
businesses, yes, Rachel, can you hear me? Rachel, can you hear me?
Yes.
Okay, I was saying that we have tax rates for people who are dealing, we have tax rates for people who are dealing in small business. And now the word is small business. It is,
this network is so poor.
in this perspective, it is defined according to the threshold.
I can hear you, please proceed.
Small businesses are defined according to the threshold. If a person has a business and the turnover in that business is below 150 million Uganda shillings in a year of income in 12 months period, then that is a small business. Okay? That is a small business. And their rates are different. Okay? Their rates are different. For them, they will not pay tax basing on profits. If you have a small business and your turnover is below 150 million in a year of income, you will not pay tax basing on the taxable profits. You will pay tax basing on your turnover. Basing on your turnover. And even that, it will be categorized more. If you have business records, your rates will be different, a little smaller. If you do not have business records, still your rates are different. Okay? So the only difference between the other category that we discussed earlier and the people dealing with the small businesses is that the tax for people dealing with smaller businesses is not based on the taxable profit, but it's rather based on turnover, which turnover must be below 150 million in a given year of income. And no expenses will be allowed for a person dealing with a small business, given the fact that tax is based on turnover. So no expenses will be allowed. We shall just get the turnover, apply a certain rate, all the amount, the tax for that band, and that will be the end. You will have to pay that tax. I had left it out intentionally, thinking that, no investor would come to invest in a business in Uganda with a turnover of below 150 million. So that's why I had left it out. but I hope it is clear now, and that is only for income tax. That is only for income tax. For the other tax types,
So I would like to clarify for you, Jim. Not everyone that is watching is an investor. They're just yes. So I wanted to make a clarification for you because we have very many foreigners who come to Uganda, but they are not investors. Being an investor requires a lot of money. You have to show, I believe, $250,000 to Uganda Investment Authority. You don't pay it, but you just show it to them to be able to become an investor. So we still do have foreigners who want to come to Uganda to do a business, but they are not necessarily investors. They could have a good sized capital, but they might not be necessarily investors. So that's why the question came up as well. But thanks, I believe it's clear now. Yes, you can proceed.
Yes, Rachel, even when you do not qualify to be an investor under the terms of the Uganda Investment Authority, when your business is above 150 million.
Can you hear me?
Yes,
Sorry,
I
guys,
can
the
hear
connection
you.
is very slow today. But Jim, you can proceed.
Yes, I was saying that yes, you may really not be an investor to come to go through investment authority and you don't have the capital of 250, but still it will be hard for you to travel all the way to Uganda to come and do business of when you're getting 50 million in a year. Anyway, to me, it wouldn't make sense to leave the comfort of your home, your country, to come and peanuts from Uganda. But that is a joke anyway. Rachel, can I proceed?
Okay, understood. So there is a question from Roll with Liz. She's asking about taxes for online businesses.
Thank you, Rachel, and Roll for that
Oh
question.
man, today's
There are
connection is very
taxes for.
slow. But there is a question about taxes for online businesses. Yes, please. Liz is
Thank
asking
you.
about taxes for online businesses.
Thank you, Liz, for that question. I should admit that globally we are all facing challenges of taxing online businesses. But with the help of the OECD, we are getting a breakthrough. We just have a challenge of taxing online businesses. But ideally, all the taxes that I've discussed are applicable on online businesses. Because even if you're online, you're doing business on Facebook, okay, you will still be a resident in Uganda for tax purposes, and it does not take away the fact that you're not making money or you're not earning from that business, irrespective of it being online. So all the taxes I've discussed still apply on all online businesses, be it online betting, be it online shopping, Jumia, name it, they all pay taxes in Uganda. The challenge which is faced globally is probably how to tax the people doing online business. Like if a person is in London, he can still do online business and trade with the person in Uganda. That creates a challenge for taxation, but it does not take away the liability for that person to pay tax. I'm seeing a question. I'm seeing a question popping up. What business?
Okay, thanks a lot. So Fabian has another question that I'm going to put on the screen. I hope you can see it. He says, what goods and businesses are tax exempt? I believe that's the question you're coming to.
Okay.
Yes.
Thanks, Fabian.
And goods are tax exempt. Then maybe we could also dive into the topic of people who fall under the category of investors.
Okay. So this is in line with the VAT, I believe. In Uganda, the way how VAT works, they do not exempt businesses, or they do not exempt companies. What they do, they exempt items, not a company or business. They exempt items. It's upon you to venture into that business. But even when you venture into that business, it does not make your company exempt for VAT. It only makes the item you're dealing in exempt for VAT. And he has asked for the items that are VAT exempt. And like I said, they are all found in the second schedule of the VAT Act. Okay, you can obtain a copy of Uganda's tax laws from our website, that is ura.go.ug. You can access it wherever you are, provided you have internet. You can download it. But maybe to give you a few items that are included in the exempt schedule. I already mentioned exempt items to include unprocessed agriculture foodstuffs. Unprocessed agriculture foodstuffs, they are all exempt for tax purposes.
Yes, that was very clear. So is it only agricultural products? How about medicine?
Then we also have financial services. If you come, you open up a bank or any financial related services, those services are exempt for VAT. We have a supply of unimproved land. We have education services. We have the supply of betting lotteries and games of chance. If you opt to come and invest in betting, those services are purely exempt. Supply of burial and cremation services. If you come and you choose to start up a funeral company, I know we have so many in Uganda now. Most of them, they are exempt for VAT. We have supply of passenger transportation services. It is exempt for VAT. If you come and you venture into passenger transportation, you come, you buy your buses, you start transporting people from Kampala to the different parts of Uganda, that is exempt. We have supply of dental and medical and veterinary goods, to include dental, medical and veterinary equipment, ambulances, contraceptives of all forms, mama kits, medical examination gloves, medicated cotton wool, name it. And we had recent amendments which were made for COVID to have disposable face masks, the biohazardous bags, the disposable hair nets, the paper bed sheets, the disinfectants and sanitizers. There are very many. I'm just picking a few from the Act. The supply of crop extension services. The list is many. The supply of Bibles and Qurans and textbooks. So all these are listed in Exempt in Schedule 2 of the VAT Act. I can't read the list because it quite has a lot of items. I can't finish it today really. I've just picked a few. I hope I've given a good response to Fabian.
Okay, I thanks a lot. So if the Jim,
yes, please.
Okay, so I want to thank the viewers, Fabian, Arol with Liz. I thank you guys for supporting the stream. I really do appreciate. And one thing that Jim has mentioned is that actually we're also going to talk about people who are in the investor bracket. So we're going to talk about the tax holidays as well that they do have. So Jim, my question for you, I'm going to share it on the screen. If a company is dealing in VAT exempt goods, maybe like agricultural products, does it entirely exempt it from any taxes? Assume I'm a farmer and maybe I'm exporting meat, I'm exporting goat meat, maybe I'm exporting fish. Does it exempt me from all the taxes? I would like to understand about that. Of course, apart from maybe like the tax that you pay for employees, pay as you earn. If I'm hiring people on the farm, maybe apart from that tax, does it exempt me from other taxes within the company? But I'm going to share the question on the screen so that you see it very well. It's going to appear shortly.
Thanks, Rachel. I can see the question. If a company deals in VAT exempt goods, does it entirely exempt the company from all taxes? And the answer is no. If you notice, each tax type that I mentioned is governed by a different act. Every tax type has its own act. When we talk of VAT, we talk of the Value Added Tax Act. When we talk of income tax, we talk of the Income Tax Act. The income tax covers the corporation tax that I discussed, the pay as you earn, withholding tax, and rental. Those are covered under the Income Tax Act. Then you have the Stamps Act covering stamp duty. We have the Excise Duty Act covering excise duty. So if the VAT Act exempts an item, it only exempts that item for the taxes covered in the VAT Act. Okay? The VAT Act does not extend to the Income Tax Act. If an item is exempt for taxes in VAT, it only stops in the VAT Act. Then income tax will be governed by the Income Tax Act. But to give you a simple response, the VAT Act does not exempt income tax. Okay, it only exempts VAT. So if you deal in exempt goods for VAT, they are exempt for VAT. They are not exempt for income tax. So even when you completely deal in exempt items, you still have to account for your income tax. And maybe to get me clear on this, for VAT, what is exempt? What is exempt is when you're selling if you deal in exempt items, you only exempt from charging VAT at the point of selling. But it does not mean that you, when you're buying your inputs, you're not going to be charged VAT. Assuming you deal in agricultural products, you sell fruits, mangoes, what? But you need to preserve them. So you have to buy a refrigerator, which is standard rated. You have to incur electricity, which is standard rated. You are going to be charged VAT when you're purchasing the refrigerator and when you're paying electricity. But when you're selling your products, you're not going to charge VAT. So even the exemption is only on what you sell. Like I said, that VAT does not exempt a company or a person. It exempts items. So what you sell is what will be exempt. But when you're buying the goods, whatever you need, an input for your company, for your business, you'll have to pay, incur VAT, which you will not be able to claim since you're not registered for VAT because you are only dealing in exempt supplies.
Wow. Now I see why people hire accountants in their organization, because it's quite a lot actually. I feel like it comes back to the nature of the business, the size of the business, and all these little different things. It's quite a lot. It's very broad.
Okay, I think now I can proceed to an investor.
Yes, please.
So I'm going to give what the incentives that are applicable to an investor. Then at the end, I'm going to give the general incentives that are available to all people doing business, irrespective of whether you're an investor or not an investor, because you have incentives that cut across. But let me start with those available to an investor. For starters, when you come as an investor, you must apply for an investment license with the Uganda Investment Authority. And this license is only available to a company and not individuals. This license is only available to a company and not individuals. And the license, for a company to be eligible for the investment license, it must have been incorporated in Uganda. It must have been incorporated in Uganda. And that business must have or make a capital investment of more than $250,000 for foreign firms and $50,000 for domestic firms. So before you apply for the license, if you are a domestic firm, you must be sure that you're going to make a capital investment of more than 50,000 US dollars. If you are a foreign firm, you must make sure that you're ready and willing to make a capital investments of more than 250,000 US dollars. The moment you're given that license, then you can apply to get land in any one of the investment or rather the industrial parks in Uganda. depending on the availability of the land in the industrial parks. This land is basically given on lease for a given period. It's given on lease, but essentially it is on lease but free. Okay? Ideally, you wouldn't be paying those colossal sums of money to obtain that land. It is on lease, but it depends on availability. Because currently we have 27 industrial parks in Uganda. We have the Namamve, which is almost full. We have the Muzira Industrial Park. We have the Toro, the Mbale, the Kapeka industrial parks. There are 27, but it really depends on availability. However, for you to qualify for this land, you must have complied with other regulatory bodies, such as URA. That is, you must have applied for a TIN. Okay? You must have incorporated or registered your company with URSB, that is Uganda Registration Services Bureau, which is mandated with registering all companies, incorporating all companies in Uganda, as well as the immigration, for you to be able to apply for the land. So at this point, as an investor, you already have an incentive of having free land in one of the investment parks available in Uganda. That incentive is not available to any other person who is not an investor. It is only available to investors who meet the conditions set by Uganda Investment Authority. Yes, Rachel, you are saying something?
No, proceed.
Then after that, we have incentives that are only applicable to the investors but they can also be applicable to non-investors. Among them, we have exemption. Now the exemption I'm talking about is not the exemption for VAT, is the exemption for income tax. Under income tax, we have exemptions. We have a section, which is section 21, which gives exemption, income tax exemption, to people in certain categories. It can be a sector or the nature of business that you're dealing in. Okay? So what I'm going to read for you, it are exemptions given, income tax exemptions. What do I mean by income tax exemption? That even when you make a profit at the end of the year, you will not pay income tax to URA because you are exempt in income tax. Okay? So under the income tax, that is specifically under section 21, it is the income of an operator in an industrial park or a free zone or other income of any other person. Now, this is applicable to all, whether you are in an industrial park, a free zone, or outside the industrial park. And the investment capital of that operator or that other person over a period of at least 10 years from the date of commencement of business is at least 10 million US dollars. In case of a foreigner, or 3,000 United States dollars in case of a citizen. all $150,000 for a citizen whose investment is placed up country. So if you are an investor, you come to Uganda, you get a license from the Uganda Investment Authority, and you are in an industrial park, and you invest over 10 million US dollars in a period of 10 years, then whatever profit you make, you will not have to pay tax in Uganda. You'll just walk away smiling, eating all your profit because you're exempt in income tax. So there we are talking of exemptions. The exemptions are quite many, they come in different forms, but they are all bundled up under the incentive of exemption. Okay? Then for this exemption, even when you come and you invest over 10 million US dollars in a period of 10 years, even when you're outside the industrial park, okay, or if you invest 150,000 US dollars when you are a citizen and you put your investment up country, even when it is outside the industrial park, for you to benefit from this exemption, you must be dealing in agricultural goods, processing agricultural goods. You are a manufacturer, or you assemble medical appliances, medical sundries, or pharmaceuticals, building materials, automobile, household appliances, manufacture furniture, pulp, paper, printing, and publishing of instructional materials. You operate a vocational or technical institute. You carry on business in logistics and warehousing information. You manufacture tires, footwear, mattresses, or toothpaste. So for you to benefit from this exemption, you must ensure that you fall within the categories I've read. If you invest your $10 million, but outside the categories I read, then you will not qualify for the exemption under this category. So the exemption is available, but it is tagged to particular sectors or to people dealing in particular lines of business. The moment you're outside these sectors, or you're not anywhere in the line of business as mentioned, then you will not qualify for that exemption. Okay? In section 21, there are many exemptions. I don't know if time will allow for us to go through all the exemptions listed there, but there are quite many. I'm just picking out a few for the purpose of keeping time, but there are quite many. Basically,
We have
for the
time, so
invest.
feel free to.
Okay, if you have
We have
time, I
enough
can
time,
go.
so feel free to go through them.
Okay.
We have enough time. Yeah, so feel free to share as much as you want.
Okay.
Yeah.
So the other exemption is still applicable to the investment traders who have the income derived by a person from letting or leasing facilities whose investment capital is at least 50 million US dollars. In the case of a foreigner, or 10 million US dollars. In the case of a citizen in an industrial park, all are free zone for a period of 10 years from the date of commencement of construction, or in the case of an existing developer, from the date on which the existing developer makes an additional investment equivalent to 50 million US dollars. In the case of a foreigner, or 10 million US dollars in the case of a citizen. So what are they saying? That if you come, you get space in an industrial park, you set up your premises, then you let out or you lease out those facilities. It can be a warehouse, it can be factory space, and you let it out, okay? Provided you've invested at least 50 million US dollars if you are a foreigner. Then whatever income you earn from letting out or leasing those facilities, it will be exempt. So you will go scot-free, okay? In all these exemptions, they are basically tagged to the amount of investment that you're making and the businesses that you're going to be dealing in. So basically the conditions here are basically two: the level of investment and what you're going to deal in. You can invest $50 million, but you invest in a business that is not catered for in the exemption, then still you will not benefit from the exemption. Basically, these are the exemption benefits that are available to investors. But on top of these exemptions available to investors, there are other incentives that are applicable to all, whether you are an investor or any other person doing business in Uganda, be it an individual or a company. Okay? And still, I'll still rotate around exemptions. The other exemptions I mentioned were more leaning on the side of the investors. Now, these are general exemptions which are applicable to even people who are not investors. I will start with the withholding tax exemption. Withholding, like I mentioned earlier, that for any person, if you supply, the person paying you, if that person is exempt, is a gazetted withholding agent, or when you're importing, you must pay withholding tax of 6% of the gross amount of the value of the goods you're importing or of the value of the goods you've supplied. So if you're compliant, you can apply to URA and you get that 6% exemption. When you get that exemption, what does it mean? It means your cash flows are going to be clear. They are not going to be constrained. Because if I'm supplying Isaac, when Isaac is paying me, he's going to pay me less 6%. But when I get this exemption, the 6% withholding tax exemption, Isaac is supposed to pay me 100% of the invoice value. It means this money is going to be at my disposal for any other investment, okay? Unlike when I'm not exempt, that Isaac is going to pay me 96%, and the other 6% is going to be remitted to URA as advance tax. Okay? Compare yourself with a person who is not exempt and who is exempt. Assuming you supply goods worth 1 billion in January and your financial year ends in December. So the person is going to be paid less 6% of the 1 billion. And the other person who is exempt, who has the exemption, is going to receive 100%. You're already far ahead of this person because you have the 6% at your disposal, unlike the other person. So of course that already gives you a hedge over the other person, in that you can plan and invest that 6% on top of the 96%, the 94%. But that exemption is only given to people who are deemed to be compliant. And the exemption is given for a period of 1 year, renewable. 1 year, renewable. It can be renewed for all the years provided you're compliant, or it can be terminated anytime, even before the elapse of the 1 year. If you're found to be non-compliant. And compliance in that sense is determined by the commissioner. So it is at the discretion of the commissioner. It is not God-given that any taxpayer must be on that list. Then the other exemptions we have are for domestic taxes, we have the income of a person for a year of income derived from agro-processing. If you deal in agro-processing, okay, your income is exempt. Your income is exempt. If you deal in agro-processing, your income is exempt. This is irrespective of whether you're an investment trader or you are any other person, provided you're doing business in Uganda, okay? That income is exempt for tax purposes. Then you have other incentives. We have capital deductions. We have capital deductions. Assuming you're any other company, you're any other investor, you're any other person doing business in Uganda, and you make capital investments, you buy capital items, capital assets, you construct a building, okay, a factory, that is a capital item. In the first year of income, assuming you've constructed a factory, let me say at a cost of 500 million UBX, in the first year of income, when you put that factory to use, you're entitled to 50% of the cost of that factory. In this case, the 500 million UBX. That means the 50%, which is 250 million of the cost, will be given to you as an allowable deduction in that year. Okay? That, yes, we are not allowing you to claim it at once, but we are giving you 50% as initial allowance in the first year of income. Then on top of that, we have what we call wear and tear. Okay? we have what we call wear and tear and the IBD. Maybe let me start with the IBD. On top of the initial allowance that you've put up a factor, and we've given you initial allowance of 50% of the initial cost, which will be a liable deduction, meaning it will be reduced from the gross income. In other words, it is going to reduce your taxable profits. Then the balance of the 250 million, okay, you will qualify for IBD, what we call the industrial building deduction. The 250 million, you will get 5% of the balance of the 250 million for the next 20 years. Meaning at the end of the 20 years, you will have recovered 100% of your initial investment. The 50% being given in the very first year of income, then the 20% given over 5 years at a rate of 5% flat rate for the 20 years. All these are incentives given to you to make sure that before we tax you, we must allow you to claim whatever you've invested in your company, irrespective of whether you are a company or an individual or an investor. Then for the other capital investments, assuming you've bought plant and machinery, we have what we call wear and tear. Plant and machinery, being that it is not a revenue expenditure, we will not allow you to claim it 100%. For the revenue expenditure, what do I mean by the revenue expenditure? All the expenses you've incurred, okay? The expenses you incur on a daily basis, electricity, water, printing, whatever you've incurred on revenue account, those ones will be able to claim, okay? Those ones will be able to claim with restrictions, as we are going to see ahead. Then for these ones, the capital investments, assuming you've bought your computers, your plant and machinery, you've bought your motor vehicles, irrespective of which motor vehicle, you will be able to get wear and tear at the different rates. We used to have 4 classes of assets, but currently, effective 1st July 2021, we have 4 classes. We have class 1, which has computer and data handling machines. There you could get wear and tear at a rate of 40% at reducing ballast. Then we have plant and machinery used in manufacturing, that is in class 2. You will be able to claim wear and tear at a rate of 30%. Then you have all other items, not in class 1 and class 2. Those are all in class 3, and you will be able to claim 20% of the value, the initial investment. Why is this a benefit? One would ask that after all, even accounting provides for depreciation, which is an expense in accounting. Yes, accounting allows for depreciation, but when you look at the accounting standards, no standard will allow you to claim depreciation at a rate of 20 or at a rate of 40%, or even 30%. You will not find it in any of the accounting standards. So when URA allows you to claim wear and tear, it is an advantage to you away from the accounting, which will cap the depreciation to 20%. This is an accelerated depreciation, which will help you reduce the tax payable, more so in the first years, of investments. Then we also have startup costs. The amount of money you inject in, okay, in the preparations of setting up the company up to the point of actual start of business, whatever you've incurred, we call it a startup cost. You allowed to claim all these startup costs at a rate of 25% for 4 years. Here, we are allowing you to recover all the costs that you've injected in before the actual start of production or actual start of business in 4 installments. Those are 4 years, and you will take 25%. Then I talked of claiming other expenses, but with restrictions. For restrictions, let me just give a few examples. If you get a loan, you may want to start business, but you don't have the funds, and you opt to go for a loan. It can be a loan from a related party, from a bank, from a money lender, or from a friend, provided that you're paying interest. That interest is an allowable deduction. However, for interest, you can effective 1st July 2018, you can only claim 30% of the earnings before interest, depreciation, and amortization. We call it EBITDA, okay? Earnings before tax, depreciation, amortization. Assuming your earnings, the EBITDA, okay, is 100%, rather 100 million. That is your EBITDA, okay? And you have interest expense, okay, of 80 million. The 80 million is allowable for income tax purposes. But when it comes to taxation, you have to make adjustments that out of the 80 million, you have to first compute the 30% of the EBITDA, which will give you 30 million. So out of the 80 million that you've incurred as interest for that year, you can only claim 30% as allowable deduction for interest for tax purposes in that year of income. The balance of the interest is carried forward in the next years for a period of 3 years. So if in this year you're claiming 30 out of the 80 million, the balance of the 50 is carried forward to the next 3 years. So you can claim that in the next 3 years. That's why I made a disclaimer that yes, all other expenses are allowed, but with restrictions. The restrictions are not on all, okay? The restrictions are not on all. They are on selected items as per the tax laws, okay? If you make a donation, it is an expense, okay? If you make a donation, it is an expense, but it can only be allowed for tax purposes if you make a donation to an amateur sporting association, what is the other one? Or a charitable organization. That expense is allowed for tax purposes. But even when it is allowed, it must not exceed 5% of your gross income. It must not exceed 5% of your gross income. Why do we put these restrictions? That you will find someone who is in a loss-making position, but he's making donations, okay, of 1 billion, yet he's in a loss-making position. So the question would be, where are you getting this money to donate, yet you're making a loss, accounting loss? So that's why they put that limit, that yes, it is very okay to give, to donate to these charitable organizations, but your donation must be within a certain limit. Okay? Not forgetting that charitable organizations are all exempt for income tax purposes. On top of that, we have other incentives. Now let me go at importation. Okay, the incentives which are available to all people at importation. We have what we call VAT deferment. Like I mentioned earlier, that when you're importing, even when you're not VAT registered, you must pay the applicable taxes at importation. And among those applicable taxes, we had VAT, which is applicable on the standard rated items. So when you're importing plant and machinery with a value which is more than 4,000 US dollars, just 4,000 US dollars, which is about 14 to 15 million, you can apply for VAT deferment. What do I mean by VAT deferment? It is deferred. That VAT will not be paid. It is deferred at a later date. So you apply, you attach all your records relating to what you're importing, provided it is plant and machinery, and it has value of more than 4,000 US dollars. You will not pay VAT at importation. Okay? The importation can be phased importation. It can be plant and machinery, but cannot fit in one container. So it can be phased importation, that you can bring these items in 3 phases, provided that you show proof that these items you've already ordered for them and the value is more than $4,000, and you specifically show that they are going to come in 3 also many phases. You will be given that incentive of VAT deferment, and you will not pay that VAT. Then you also have specific tax exemption, depending on the item, the sector, or the country of origin. All this is at importation. The example I can give, if you have a hotel, if you come, you invest in a hotel, and you get registered with the association for the hotel owners, the moment whatever you import, it will be exempt for taxes. Whatever you import will be exempt for taxes, provided, because it also has conditions, provided what you're bringing is marked, all engraved. Okay? If you have a hotel, Jekagolo Hotels Limited, and you import bed sheets, you import plates, okay? Those plates, the bed sheets, they must be labeled, all engraved with the name of the hotel, okay? That's why when you come and you go to most of these hotels, the Serena hotels, you will see, I mean, it may look as a decoration, but they were labeled to qualify for these exemptions. Okay, now these are exemptions available at importation, but geared towards facilitating some sectors. We also have sectors like tourism. Those of you who have had a chance to come to Uganda, you will see most of the tourist vehicles have red number plates for cars. Okay? They have those red number plates. Basically, in Uganda, you get the red number plate if you are exempt from taxes. So the people in those sectors, they are exempt for taxes at importation. And if they import a car, a tourist vehicle, they will not pay taxes at importation, so they will get a red number plate. But that does not exempt them. It only exempts them for taxes at importation. It does not exempt them from VAT and from income tax. Okay? Then you also have other items that are exempt at importation. We have the CCTV cameras. Okay? When you're importing them, they are exempt for taxes at importation. The taxes are just at importation. But any subsequent resale local, all the taxes I discussed will be applicable from VAT. They will be applicable. Then, like I said earlier, the import duty that I talked about as a duty that is payable at importation, it also depends on the item, only the item you're importing, or the sector you're in, all from the region, the trade blocks where you are importing such items. And like I said, it ranges from 0 to 25%, depending on the item and on the country where you're importing your items. So when you are a trader, you are a business person, it is upon you to choose to do tax planning and say, if I go in this sector, I will not pay this tax because of this exemption. Or you can choose to import your goods within the East African community if those goods are available in the East African community, such that you get the preferential treatment when you're importing those goods instead of buying them from other countries which do not have preferential rates.
Okay, thanks a lot. So that's quite was very detailed. I've learned a lot. So is that concluded with the tax exemptions?
Yeah,
And I believe
basically,
all this information can be found on your website as well.
yes, it is. All this information is in the Act. The exemptions which I've given at importation, some of them are in the VAT Act, others are in Schedule 5 of the East African Community Customs Management Act. Whatever is listed in Schedule 5 of the East African Community Customs Management Act will be exempt for VAT, but only at importation. So what I have discussed is basically the exemptions, but they are not conclusive. The exemptions are quite many, but they can all be accessed in the various provisions of the various tax laws, that is the Income Tax Act, the VAT Act, which can be got from our web portal, that is ura.go.ug.
Okay, so you've talked about the preferential treatments or preferential rates under the East African community. Is that also available for if I'm importing from COMESA countries and also from AGOA? Because I also know that we have, like, if I'm importing things from the US, is AGOA applicable or it's only for when you're exporting? I know we have some treaties with maybe the European Union as well. If I'm importing things from Germany to Uganda, maybe from China to Uganda or from India to Uganda, are there any active agreements that are going to favor people? Because I know we get so many things from China, like us Ugandans. Are there any agreements that are going to favor people when it comes to import duty?
Currently, what we have are the trade blocks within Africa. The trade blocks within Africa, the East African community, the ECOWAS. Those are basically currently which have preferential treatments. For anything outside Africa, we do not have any arrangement for preferential treatments as of now.
Wow, thanks a lot. That was very informative. So I would like to ask you more about when you say, for example, the tourism sector, they can easily get exemptions when they're importing vehicles because they are in the right industry, and maybe I'm believing health industry as well if you're into health. So does that necessarily, is that entirely determined by the type of industry you're in? If you were to get an exemption when you're importing a car, of course, to do the business, or does it also depend on a tax on the amount of money? Because I remember you earlier mentioned that if someone has a turnover of over 150 million UGX per year, that's about how many US dollars? Maybe of almost 40,000 US dollars. I'm assuming. You said they'll qualify for some tax exemptions. Would you clarify a little bit more about that?
I beg your pardon on that, Rachel.
Is my question clear? Okay. So you said, you gave us an example that people, for example, in the tourism industry can import certain goods. For example, if they are buying a car, their car will have red number plates because it's within the right sector. Maybe the government is trying to promote the tourism sector in Uganda. So you said that will either depend on the sector or the industry in which someone is in, or it will also maybe depend on the product that they are importing, because you've given us very many types of products. So when it comes to importing cars, does it necessarily come back to the sector alone, or can even people out of tourism import cars and not pay taxes?
Okay, for cars it is quite different. It may depend on the sector or the nature of work. The nature of work you do. Okay.
Have you heard
The
the question?
sector.
I know our network is very slow today.
The sector, like I've said, if you are in tourism sector and you import tourist vehicles, okay, you can import and do not pay taxes. Even when you're exempt for taxes, because for the tourism sector is not exempt for income tax, but even any other person that is exempt for taxes, the moment you're importing that vehicle, you do not pay taxes. The other people we have that do not pay taxes, we have the returning residents. If you are a resident in Uganda, you're coming back home, you have your car, provided you prove that you've been using that car, wherever you've been, for a period of more than 1 year, then you will not also be required to pay taxes for that car, even when it is not for business. So for the issue of the car, it depends. It really depends on the circumstances, because even individuals who are not in business can import those cars and not pay taxes.
Okay, thanks a lot for the insights. I believe we've talked a lot. The chat was very educative. and very informative. So I really do appreciate. I think the taxation thing is very broad and very large, but I'm sure the viewers enjoyed it, and people who come here later will still be able to learn a lot. So I really do appreciate. Yeah, it's already 1 hour and 50 minutes, so I applaud you for doing most of the talking and saving me the talking. I appreciate that. And I think we can end it here. Do you have any final words or final thoughts that you'd like to share in regards to taxes?
I don't know if there are questions for starters for this last bit of the presentation.
No, no, we don't have any questions actually.
I hope not having questions doesn't mean that people did not get anything in the last bit shared. All I didn't go them for that case. But that aside, I really thank you for organizing this chat. I hope it has been educative to the people who came along. And taxation, like you said, is really wide. I don't want you to say that whatever we've discussed here, I've given you all what you need. No. What we've discussed is basically a small portion of the taxation, the Uganda's taxation. But I really think that we've benefited the viewers, and we call upon those who are willing to come to Uganda and invest. Uganda, we are very peaceful people, very welcoming. We shall provide good ambience for their investments. Other than that, I really thank you for having organized this, and I also thank Isaac, my colleague here, for having organized this entire thing. He is the one who has been coordinating here and there. I really thank him, and you, Rachel, for having made this happen. Thank you so much.
Okay, thank you for taking your time to come as well. I do really appreciate, and I'm sure this is not the last discussion we're going to have. I'll reach out to you for many more, and you'll keep educating us. So I look forward to the next one, and yeah, have a good night.
Okay, good night.
Thank you so much, guys. I hope you've learned a lot from this stream. It was very informative. Taxes is a very wide. So if you come here later to watch the video, then make sure to leave your questions and all your comments in the comment section. I can always reach out to Jim, and he's always available, to tell us all about taxes. And just like you said, he has said the URA website is www.ura.go.ug. That is the website for the taxing body. And yeah, I appreciate everyone who joined the live stream. I thank you so much, guys. A like, a share, subscribe, and I'll see you guys on the next video. Bye.